Hi, everyone. I am Quin Garcia. I'm one of the managing directors of Autotech Ventures, and I will be your moderator today for our panel on seed stage marketplace startups. And I just want to start by, I think we have about 25 minutes or so. I think we're running a few minutes behind schedule, but I think we're on track for about 25 minutes. And we'd like to make this interactive with all of you. So please do chime in with your questions. I'll start by asking our panelists some questions in the beginning, but would love it if you guys can raise your hands and chime in with questions of your own. So I'd like to just start with a quick poll of who is here. So can you please raise your hand if you are with a startup? Holy cow. Okay. A lot of people. And can you please raise your hand if you are a seed stage or so startup? Also a lot of folks. Okay, this one's for you. So we have our three panelists, three great VCs, really active in seed stage marketplace startup investing, and their bios should be in the pamphlet. Maybe Iris's isn't, but they should be mostly in the pamphlet. And I'll just ask them each to share one or two sentences on who you are, and then we will dive in. Iris, please.
Yeah, hi, I'm Iris Choi. I'm a partner at Floodgate. We're a seed stage fund based in the Bay Area. We're fairly evenly split between consumer and enterprise.
Hi, I'm Stephanie Palmeri. I'm a partner at Uncork Capital. You may know us with our former name as Softtech VC. We're based here in San Francisco and down on the peninsula, and we invest in early stage companies, generally being the largest or second largest check in a seed round.
Hey everyone, thanks for being here. My name is Malley. I'm a general partner at Forerunner Ventures, and we do seed and Series A, and we really think about the changes in the consumer journey and the kinds of companies that help support that.
So let me ask you guys, what are the traits or the markers of seed stage marketplace startups that you're looking to fund?
Sure, I'll kick that one off. So we really look at the founder's understanding of the demographic behind both sides of the equation. So do they understand the people who are doing the work? Do they understand the people who are the buyers? And does that specific understanding help them shape the kind of service they want to offer? So if you think about like Tony from DoorDash, he was doing deliveries himself for lots of other companies for several months before launching his own. So that sort of intimate knowledge of what people go through and what people want is a great archetype when we think about the types of founders we want to work with.
So really know and empathize with both supply side and demand side.
Yeah, and understand what are the constraints and what actually matters to people, because even though you're looking at it from a spreadsheet and trying to understand the math, at the end of the day, you're trying to get people to do things that they maybe weren't doing before. And if you don't understand the people, it's going to be really hard to build a company.
Yeah.
I think the thing I'd add to that is we also, obviously we saw how many marketplaces are out there, and a lot of these horizontal businesses are now being disrupted by vertically focused businesses. So I think the question we think about at Seed, when there is a lot of capital and a lot of emphasis behind existing platforms, is how specifically is what you're doing really, really unique and going to resonate. It may resonate with a really narrow audience at the beginning, but it's understanding how you really see a very focused and truly different enablement to that group, and then how you see expansion beyond it. Yeah. So, and that will change over time. For example, when we first invested in Poshmark, what was unique about Poshmark, one of the things that was unique was mobile only, right? Now, we're at a different day and time where I think being mobile only isn't that unusual, but in 2011, that was quite a differentiator for the marketplace.
Mm-hmm. Yeah, and I think given how early all three of us invest, I think it's less around the metrics and more about the nuances. And so given in Floodgate's experience, a lot of the marketplaces we've invested in have been two-sided, trying to have a sense for whether there's a viral loop or some kind of network effects where you are not struggling to bring in both the supply and the demand side, but that at some point there will be a flywheel effect where both of them will start becoming populated is really important.
Mm-hmm. Mm-hmm. And so let's say you guys invest in one of the startups out here. What do you want them to focus on in the first 12 to 24 months after your investment? And what are some of the temptations? What are some of the things that you commonly see them tempted to do that they should just really discipline themselves and avoid doing?
Yeah, I mean, I'll go first. I think that for us, it's twofold. One is related to what Brian had just said, which is you want to start seeing evidence of product market fit after you start deploying your seed capital. And a lot of that is empathy for the people involved in the actual experience. Like, what is that moment of delight, whether you are either the demand or the supply side, right? And any participant within that marketplace, and building towards proof that people are enjoying the experience and thus will likely repeatedly engage in that service. I think the second part in terms of what to be wary of is, while we are all focused on seeing growth, because that is hopefully evidence of traction, not having it be artificial, right? That even from the seed stage, wanting to know that there is a basis of strong unit economics that can be built upon.
So continue to empathize, post-investment, no fake growth. Yeah.
That's right.
I think that chase for GMV is a really big issue. I think a lot of times founders think the top line number is really what matters. And, I know obviously the next level of investors cares about that, but not in absence of the unit economics. The thing that I like to have our companies focus on is thinking about what that halo metric is that allows you to know early on. It's the early indicator or leading indicator that things are working. So for a lot of marketplaces, there's many steps that a user has to go through, whether on the buyer or the seller side, to actually enable a transaction to happen. So just simply joining a platform or registering or putting up a profile isn't necessarily enough. For a driver, it may mean completing your first ride, right? For a seller on a marketplace, it might mean completing your first sale, right? So what are you doing to enable success on your marketplace and laser focus on making sure as you add new people to the platform, they're being successful in what that halo transaction metric is?
You'd rather be important to a small set of people than interchangeable to a broader set, where if you were to go away tomorrow, they just wouldn't really care or even notice.
So kind of the white hot center. I think James Courier is that's one of his phrases there at NFX Skill. Where's James? There he is. Nice. Okay.
Wearing branded apparel.
So I want to ask you, after the, let's say, first 1 to 2 years post investment, if you go back and if you look at all the successful exits, not necessarily just in your portfolio, but in general, successful exits, how do you back correlate that? What do you see as traits that are beyond your first year or two that they continue to do after that first year or two that are highly correlated to successful exits?
Yeah, I think Roger actually talked about this a little bit earlier, but you're looking for companies where they start out with a narrow wedge and they find a way in, but they become more and more important to their demographics over time. And so that might mean that they start to own a larger chunk of their business. That might mean that they start to take a larger share of wallet. That might mean that they start to cover payments or cover more areas. But it's really looking at like which companies are building a moat and that they have the right relationships, where increased customers means improved economics for everyone around. And that's how you end up with stickiness. And that's why I think some of these marketplace companies have been really successful as public endeavors, because they end up being really hard in the early days, but they end up being very sticky over time.
I think to add to that, if you think about it, and for all the founders in the audience, this is really hard, and you're going to be building this for better part of a decade or more. And so the quality of persistence and grit is, I think, probably one of the most important things in these teams. As these businesses evolve from what you do in the early days, duct tape and bubble gum, things that don't scale, to each step function of change, it really is around that persistence of you and your early team, and then the continued persistence of the folks that you bring on to get through all of these hard things.
Yeah, I think the importance of the founders and the teams can never be underemphasized, right? Especially given the stage that we invest in, which is so early. And the expectation going in is that the company, by the time it exits, will probably look very different than what our thesis was going in. And yet, hopefully, the founding team is still there in terms of leading the actual company.
So you do see some long-term correlation between existence of founding team at the time of exit, as opposed to swapping founders out along the way.
I think from a Floodgate perspective, we haven't had that much experience, to be frank, about having founders no longer be part of the team. I think in terms of specific titles, that may be more nuanced.
Yeah, makes sense.
Yeah, over time, like the job of a founder changes dramatically. And if you think about the early days, you're really doing everything. And at some point, you want to almost be doing nothing except bringing on great people and making sure that everyone understands the vision and making sure you don't run out of money. And so the ones that continue to up-level the talent, because the kinds of people you need to launch a city versus get a city to $100 million are different people. And so the folks that get ahead of that curve and really understand where their team shines and where they need to fill it in, they're the ones that tend to scale really well. regardless of what their previous experience was before starting the company.
So I want to ask you guys a question about in what way you are contrarian. So as you guys read and listen to entrepreneurs and venture capitalists and experts out there, and you hear about people's kind of widely held views of best practices related to marketplace startups, successful marketplace startups, what would you disagree with? Which views out there would you say, you know what, actually, a lot of people are talking about this, but this just doesn't align with my experiences?
Well, I think for us, one is the point that I made earlier about we focus on unit economics even in the early days. And then I only bring that up because we're a smaller fund on the spectrum. And so when I speak to some later stage growth funds that are very deep pocketed, they may take a different perspective about what's most important is that you get to majority kind of scale or ownership of a marketplace. And once you have dominance, then you worry about the unit economics. But we often say to our founders, congratulations on raising your seed. That's the last money you'll ever see until you've earned the right for an A. And so we're big believers, again, from the beginning of making sure you understand what your unit economics will look like at some point and how you're going to actually get there.
So if they don't look great in the beginning, at least show me a clear roadmap
Yes.
for achieving that. Yeah.
I also think for a lot of these businesses, the expectation is that there's going to be a lot going on behind the scenes from a technology standpoint, and this may be contrarian to say, but I kind of expect to see a lot of duct tape and bubble gum holding stuff together in a lot of these early businesses because, quite frankly, you actually don't know what you need to build. And I think there's a lot of teams that go down the wheel of trying to build some sort of superior experience for very, very narrow set, and then you launch and build it and they will come does not actually happen with a lot of these businesses. So I think being intimately familiar with your users and then building what they need or what you learn they need over time, not necessarily them telling you to build it, but you learning what do I need to enable this transaction to happen smoother is I think very helpful. So that need to continuously experiment. I think I don't expect at seed that a lot of things will actually be fully formed.
So I tend to think the whole concept of first mover advantage is off. So you look a lot of times it's like this desire to get into as many cities as you can, as many markets, be there first. But once people have experienced a service and it's now part of their daily life, they're now open to someone that treats them better, or someone that gives better pricing, someone gives better alternatives. And if you look at Lyft over time, they've done a really good job of making people love their brand and giving people a differentiated driver experience. Tipping is something that I think has been widely talked about, where you don't feel like you're back in a cab in 2009 again, just with a better system to pick it up. You actually feel like it's a better service experience. And so I think a lot of times people just want to get in the market, but they don't really understand their business. And so you sometimes see people then roll it back, understand their business, and then try to offer a differentiated service at the end of the day. Because that's really what consumers care about. They don't care if it's a marketplace or not. They just want a service that works for them. And so first mover advantage isn't always the most helpful there, aside from capital raising.
I want to ask you guys about your misses, your anti-portfolio. So what seed stage marketplace startups have you all missed, and what did you learn from the experience?
Yeah, so for us, this is one of the logos that had been in the prior presentation. I think whether you would qualify it as a marketplace is probably kind of open to interpretation, but we had seen Pinterest, hesitated, and just in that moment of hesitation, I think Andreessen Horowitz gave them a term sheet instead, right? And again, for a fund of our size, the likelihood that we can compete on either size around or valuation with an Andreessen Horowitz is really challenging. And so it definitely taught us a lesson around the sense of urgency, which we had often already felt, but just exemplified why you need to move quickly, and really is our responsibility to uncover these founders and these opportunities before anyone else.
So personally, I think anything I've missed at this point hasn't actually achieved an exit success or is filed. So I think I'll refrain from commenting that. But in terms of the fund, we missed Uber, we missed Airbnb. I think it's very easy to make assumptions about companies. With Uber, one of the stories we had behind that was at the time Travis actually wasn't going to run the company, and so the pass initially there was, hey, we believe in you as a founder, but you're actually on the outside as chairman. And so I do think sometimes who's actually going to run the company and Franz Band's team, it changed very quickly. The reality is the firm tried to move fast on that, and we were too late. So we look back and did we pass for the right reason? reason or the wrong reason. I think we knew he was really critical to the company. At the same time, 3 weeks, 4 weeks later, he was running the company. So.
Yeah, I think for me, a lot of the ones I missed, I just didn't meet, and whether that was like I didn't know about it or I didn't prioritize it. I think the most jarring one though was really Trulia. So Roger knows this, but like Pete Flynn was like literally an intern, at our firm, and was going through all these like Craigslist scraping things, and we're like, what's he working on? And he was raising like a $2 million round, and I think the lesson coming out of that was like we should be doing seed investing, because at the time we weren't as active in seed investing. And that was like as much of a slap across the face as you're gonna get, is having the guy who's literally in your office and build, I think it was a $3.5 billion outcome. So amazing founder, amazing company, and we just missed it.
So I have one more question for you guys, and I want to open it up to all of you. So please get your questions ready. So I'm not a marketplace startup expert. I'm a mobility guy. We do invest in quite a few mobility marketplace startups. So I want to ask you, aside from what's already in your portfolio related to mobility, are there any other mobility marketplace domains that are exciting to you?
So we're spending a lot of time looking at logistics companies, especially kind of the last mile network. And so that's an area where you'll see us make a couple of announcements in the near term.
Mm-hmm. So last mile, not long haul trucking, but
A mix of both, actually.
A mix of both.
Yeah.
Okay. Nice.
I would agree. I think commercial transportation is an area where we spent a lot more time in the recent years. One of the challenges I'll say at Seed is, as we've had this shift back to actually being more asset heavy in terms of the next wave of mobility, it's not necessarily a great fit for a seed focused fund. So what I'm also interested to see is, as we've made this shift to now asset heavy, have to own the company has to own the scooter. Will we see another shift, and maybe not today, but will we see another shift later towards more of the get around model, shared ownership around those things, which could be a better fit for a fund of our size.
Mm-hmm.
So we tend to think a lot about demographics and like what's going on in people's lives. And we invested in a company called Shuttle a couple years ago, which is really focused on kid transportation. And it didn't work out, but it wasn't because of a lack of market opportunity. I think a lot of parents trying to get their kids from one place to another is a real challenge and a very real problem. But the approach they took was really modeling it after the Uber's, Lyft's sidecar at the time, in terms of there's a very clear driver demographic that's driving a half hour in to service this area and then going back. And that model just doesn't work for the episodic nature of when kids need something. I think it also works on the elderly side. And so thinking about it a little bit more as a community service, where the people who are in the community might drive one day, might get a ride another day, but where it's less about people coming from a half hour away and delivering a service, and are very much the supply side. But thinking about carpools, ride sharing, things like that for the elderly, for children, for different demographics that don't really fit into the traditional use case of a Uber or Lyft or something like that.
Mm-hmm. Mm-hmm. So let's open it up to all of you guys. I think we have about 5 minutes left. Any questions? Yes, sir.
I'm Kim from Bullet, and having experienced problems of solving the chicken and egg problem in the two-sided platform. Do you have seen any founders having done some really brilliant hacks or spectacular bloopers in trying to solve the chicken and egg problem?
So how do you solve the chicken and egg problem?
I think one of the things that a lot of our companies think about is like, what's single player mode look like, right? So is one half generally the supply side, generally not the demand side, but it can vary depending on the marketplace. Is there something you can build specific to one side? Well, they're going to come in and use it on a regular basis, maybe to manage their business or manage some aspect of what they do, that there's value in participating in that piece without actually having the volume or the demand on the other side. So again, not knowing what your marketplace is, it's hard to answer specifically, but think about, is there a single player mode?
I think in terms of kind of lessons learned, there's also the aspect of specific to whichever marketplace you're creating, what are the elements that are important to the participants? And so one of them, if it's a services-based one, is often trust. And so we were also investors in TaskRabbit, and we often got the question of, why don't they just turn on the service everywhere? And their response was, because this person's coming into your home, right? And so when they went and did a city-by-city rollout, they would actually seed the market first with people that they had found, specifically train them to offer a certain level of customer service. And so I think there's those types of very particular to your business model questions that you have to answer as well.
Mm-hmm. Mm-hmm. Yes, in the back.
Ryan from Jiffy. I've got a question about getting from seed to Series A. Are you seeing
So the question is around the timeline between seed and Series A, seed extensions, metrics. How's that evolving from seed to Series A?
I'll share what we're seeing in our portfolio because we only invest at seed, and I would say not every company. I'd say probably half the companies we invest in come to us having not raised any capital before, or maybe very small amounts of angel capital. The other half has probably raised a pre-seed fund from a more institutionalized firm or two. So maybe they come to the table having already raised $1 million. On average, I would say our companies probably are raising $3-ish million before they get to Series A. Some raise less than that, some raise more than that. The reality is it's more than they've raised historically. And so, yes, there may be a longer period of time from seed to A because there may be 2 rounds there. Sometimes it's a seed and a seed extension, sometimes it's a pre-seed and a seed, sometimes it's 3, right? But by nature, it's not necessarily that they haven't hit. The metrics are, the bars, I think the bar is getting higher at the next level. But the reality is companies also have more capital to play with because of the multiple rounds that do exist at seed, so they have the luxury to wait as well.
Yeah, I think the seed stage firms really manage dollars, and so they're able to put a lot more bets out on the table. Series A investors really manage their time, right? And so a lot of them have been doing this for a while. Their early companies haven't exited, so like board capacity is high. And so I do think that when people are thinking about Series A investment, it's not about like the $5 million check or the $6 million check. It's about like, hey, do I want to spend another 10 years on this company? And I think they're looking for more demonstration that something's actually working a bit, as opposed to saying, hey, I like these people, I like the market, let's see what happens.
I think we had a question in the front.
So for your seed investments, like when you come into an initial deal of a company that hasn't raised any money before, do you typically see that they have like a growth playbook? So like every marketplace has that playbook that they have. Is that already in place, or are you investing in an idea and a small team to kind of get to that point? I know you touched on getting to product market fit after your raise, but like where in the company's kind of life cycle?
So the question is how mature is the growth playbook typically at the time of a seed stage investment? Is that right?
So I don't think our expectation is that you have a playbook when we invest, but when we are meeting with you, we will definitely push you to better understand your own thinking, right? And that's to us more insight into how you as a founder are thinking about building the business versus us expecting to hold you to your word as to how you said you were going to do like a city by city rollout.
I think some of it is also like, what's the relationship you already have with the investor? So like, we'll give people like relatively large checks who have done nothing, but because like we know them, we believe in the market, and like we have confidence they'll be able to build something. If it's someone who we don't have a relationship with, we're not so sure about the market, they might need to like demonstrate a little bit more. I think that's one of the hard things, like when you read the announcements, is knowing what was the context that led into that investment, because it might be something that they were working on a project for 2 years and just trying to find someone to go after it, versus a market where you're like, we actually lost a lot of money in this category. Like we need someone to do a little bit more before we put something in this time.
Guys, let's give it up. We have Iris, Stephanie, Brian. Thank you.